everyone. Welcome to SCV Means Business. This is the podcast of the Santa Clarita Valley Economic Development Corporation. I'm your host, Holly Schroeder. And with me today is the man who serves as SCV EDC's economist, Dr. Mark Schniepp from California Economic Forecast. Welcome, Mark. Thanks for joining me today.
Okay, well, thank you.
So last month we did our annual economic outlook, and we talked about what was happening in the national, state, and local economies. And I have to say that the data continues to be, or everybody seems to still be somewhat confused and not clear on exactly what's going to be happening. Lots of different conflicting pieces of data. So why don't we start by sort of how you synthesize what's been going on, including what's happened in the past month. We've had a jobs report and an inflation report. What are the things that you think are most important to be paying attention to, and what do they tell us about the economy?
Okay. Well, there's so many different economic indicators, of course, that get released on a regular basis. And yes, as you rightly said, they can be quite confusing. And right now, if you listen to any of the talking head shows on TV, a lot of them will tell you that, they think we're in recession, and a lot of them will just are adamant that we're in a recession. Well, you really can't have a recession with the labor market being as strong as it is right now. I mean, the unemployment rate with the jobs report that you're referring to that came out just a few days ago, it indicates that we're falling back down to 3.5% unemployment. Still had a lot of jobs being created, and even more revised up from the previous month. So the labor market is still quite strong. I mean, it's amazingly strong. And there's a number of economic indicators that are still showing relative strength. I mean, relative strength for as weak as people really claim the economy is right now. But it's really not that weak. However, the issue to sort of clarify some of the confusion, and here, get this, the second derivative is negative on most economic functions. So what does that mean?
What does that mean?
It means the change in the change is declining. Which means that, yes, things are still growing in many indicators, but they're growing at diminishing rates. And that's a little scary, because that diminishment we've been watching month after month after month. So, and some of the indicators have actually now gone negative. So we are on a trajectory right now that seems to be leading into the conclusion that we will be in a recession probably by early next year. So right now we're not, although, as I called it in the Outlook conference, we're in an ambivalent economy, because while many of the indicators are still quite positive, people still have all the work that they want. Even household incomes are still rising, and household debt is at still all-time lows, so people aren't necessarily overspending with their credit cards or anything else for that matter. But nevertheless, they're very pessimistic about the economy, about the prospects for the economy going into next year. So that's the ambivalence that exists. It still does exist. We could avoid it if the Federal Reserve does ultimately achieve its major goal, and that is to reduce inflation and at the same time not get us into a recession, not push us into a recession. But I think that's going to be a very tricky and difficult thing to do. So if that's why I was telling everyone at the conference, and I'll tell your listeners today, you probably need to brace, probably not for a real difficult one, but you need to brace for a recession going into next year. So make your plans accordingly right now.
So we'll come back to that, because I think that's kind of a key takeaway. But let's talk about that pessimism. I mean, is that because obviously inflation is going on, and so what people are seeing, at the gas pump or at the grocery store is affecting it? Because you're right, all other factors, their incomes are up. A lot of people have had appreciation, and homes are locked in a low rate if they bought a home in the past 5 years. So what and again, they seem to have job choices. So what do you attribute some of that pessimism to? And are we going to talk ourselves into a recession? What's your take on?
We could. Okay, so there are some major factors, which you will agree, most people will, that are causing people to be very uncertain about the economy and promoting this pessimism. One of the biggest ones, of course, is the erosion of the stock market and the erosion of people's retirement accounts and even their normal portfolios. So the stock market's not helping, not at all. And then the high rates of inflation, the going to the gas station and having to pay double for gasoline, or having to pay significantly more for basic goods in the store, or not being able to get some of them. I mean, I still can't find certain things when I go to the store. I mean, some of the craziest things, like you go in and you try to find something like coffee creamer. It's not there. It's completely gone from the shelf. What happened to it? And when we still have this baby formula issue, which exists. So hopefully we can get by that. But in general, the supply chain connection is starting to come back, and you'll probably start to see fewer shortages going forward. But right now you have the stock market erosion, the fact that real estate is starting to, definitely soften, and everybody's seeing that. The high rates of inflation, and then the non-economic factors, which I haven't mentioned yet, which I really think are taking their toll on people's psyche, and that is the government leadership that we're seeing now coming out of, well, not only our state, but out of Washington. The problems with the border that we're seeing, the problems with a lot of the woke behavior that's been going on, the allowance of men and women's sports, and a lot of these things which have really shocked a lot of people because they go against traditional family kinds of values. So I think a lot of these very recent, sudden, and to a large extent, in many people's minds, draconian changes that we've seen since the pandemic hit have really confused people and made them a little bit very negative on things going forward. So that's the problem with the pessimism.
Certainly that polarization just does often feel just like a cloud over every discussion, and certainly every talking head show, as you refer to them. That I can see how that would weigh on people's psyche, and it's not. I don't want to necessarily belabor that. But it does affect consumer confidence and your outlook. You talked about the retirement accounts, the stock market, declines this year. One of the things you talked about at the conference was how many people did retire during the pandemic. The baby boomers who are, of course, are reaching, retirement age every day. Is that going to reverse that? Are people going to unretire? What do you kind of see happening with the labor force, and what's the impact on those that have retired and those who and the size of the labor force going forward?
Well, that's a good question. Some people are unretiring, particularly because, and we've seen that in the last 6 to 8 months, because remember, the stock market hit an all-time high on January 3rd of this year. So it's now down 20% in the first 9 months of the year. So that can be, and it can be larger than 20% for depending upon your portfolio. So that has caused some people to want to come back to work, and so we have seen a little bit of that. But in general, I don't think we're necessarily going to see people unretire. I think what we're going to see is the labor force is going to finally ultimately catch up. I mean, you've got more people in our universities and colleges enrolled than ever before in the history of time. So those people will ultimately graduate and join the labor force. Same thing in high schools graduating. So those people will come into the labor force. So the labor force is definitely going to continue to rise. It's just going to take some time to catch up. So we're sort of in that interim period of time in which the labor force has lagged, and yet we have had this strong job growth. But that'll take a year or two or three in order to catch up with itself. And the recession will only accelerate that reconnection that will occur, because then we won't need as many people with the recession hitting and demand going down. So look for this labor force issue that has really been one of the cruxes of the economic dilemma this year to reconcile itself over the next year or two and not be the problem. But as I said in the conference, yes, we've had an extraordinary number of people that have retired. And maybe what I didn't mention as much is we've had a lot of defection from California, people moving out. And for the first time ever, the last year or two, California's population has actually declined for the first time ever. And it's due to the defections and people leaving the state. So those are the two things that have caused this labor force issue, and the fact that we can't get enough people working, and therefore the need to fill jobs is one of the biggest issues in the workplace right now. And so that's another thing that's kind of frustrating employers and making people a little bit pessimistic about the economy, is the difficulty with the labor market and being able to do business previously like in California like they had before.
Yeah, we've definitely, that's the number one thing we hear from our companies here in Santa Clarita Valley is their challenges finding workers who come every day, and that they can train. They're even like, we'll train folks. Everybody's willing to train. It's just but it's finding people who are willing to work and are wanting to get there. But the other dynamic that I have found interesting is we also had a lot of business creation during the pandemic. And I think job creating businesses. So is that like, well, I got laid off from my job during the pandemic, so I hung up my shingle and started something new? What do you think's going on behind that trend?
Yes, that definitely has happened. It's this idea of the Great Resignation. A lot of people quit. We see tons of quits, and yet those people haven't necessarily gotten on another W-2 type of job. They've essentially started their own thing, and so we've had, as you rightly said, a tremendous increase in business formations right now all over the state. So yes, and so we've had lots of business job creation, lots of business creation, and so that has been extraordinary in California. And that's another thing that's propelled, of course, the growth in California. California's actually doing better, a little bit better than the rest of the nation right now, in terms of job growth and in terms of just overall vibrant business.
And we here in Santa Clarita Valley, we're doing okay. I mean, we've brought back almost all the jobs that we lost in the second quarter of 20 at the beginning of the pandemic, which obviously hit us pretty hard with a couple of our major employers being functionally shut down for a year. But we've brought back most of those jobs and had new job creation to kind of put us back to almost where we started.
Yeah, the labor, you know what? And yet we seem to key in on that point a lot. Are we back to where we were before? It doesn't matter. It really doesn't matter now, because it's the labor force that is limiting us being back to where we were before, not the fact that there's not the demand. So it's the fact that we had too many people retire or too many people defect, and we can't get those workers back. But for all intents and purposes, we have a fully employed economy. Anybody that wants a job can get a job. As I've said, many times before, if you can fog a mirror, you can get a job. We're in that kind of an environment right now. The unemployment rate is extremely low, extremely tight. This is true almost throughout the state and in many professions. So it really doesn't matter that we may not be back up to pandemic levels. That really doesn't, that's a talking point for a conversation. but it really doesn't mean anything from an economic standpoint. And as I said, as the labor force growth, starts to rise naturally with graduating high school seniors and graduating people from colleges, you'll see the labor force pick up again. We'll have enough people to start filling a lot of these jobs that are vacant. And then the recession, of course, is going to limit some of the demand as well. So a lot of this will all come together. The big issue that we don't know about looking forward is how severe of a recession do we face in 2023. Hopefully it won't be more than a ministerial type of recession, but we don't know. We don't know how that's all going to kind of work itself out.
So what advice would you give to business owners, business leaders right now? As you said earlier, they should prepare for some form of recession in 2023, not knowing how hard a landing we might be facing. What would you tell them to be looking at and paying and doing to prepare?
Well, likely really look at your labor needs, because if you can get by without having to hire on a bunch of people and still be able to produce, make the same number of sales or produce the same amount of output, that might be the best course of action over the next year, because you don't know how the demand for your services, your products, or your output is actually going to be impacted over again the next 12 to 18 months. Hopefully that's not going to be a big issue. Hopefully the recession in Europe isn't going to last a long time. The war is going to be over. We're going to be able to get back to a little bit better energy situation worldwide. The famine that has occurred in the world, some of the droughts that, of course, we're seeing, particularly here in California, those will be resolved. We'll get the same kind of food production. We won't have all this climate alarmism that's been going on and causing us not to be able to develop our energy resources. Hopefully that will sort of moderate over the next few years. Otherwise, we face sort of extremes, and we don't know how it's going to affect the economy going forward. So right now I'd say be cautious about, labor. Be cautious about your international markets too, because we don't know how global demand is really going to change. And watch, the economic indicators that are coming out on a month-to-month basis. Be aware of kind of what's going on so that you don't over-inventory yourself.
Yeah. Are you seeing and hearing in the data investments in automation, robotics, and even just general reshoring, if not to the U.S., to North America? I mean, what are you seeing in terms of that, and what does that mean in terms of economic opportunity or economic risk, I guess?
Well, the risk would be a lot less if we could bring back a lot of the processes that we have strewn out throughout Asia. That's for sure, and even Mexico for that matter. And some of that's coming back. There was a much bigger effort to bring that back under the Trump administration than there has been under the new administration. So we'll see if any of that changes, if Congress changes with the upcoming elections, and whether that'll be a much more bigger emphasis on the part of new laws or subsidies that encourage more onshoring. So we'll see how that goes, because that would make things a lot safer, given what we've seen from the pandemic. But I haven't really seen a major change that way, not yet. No, and yet we probably need to weigh our risk with the costs issues that are driving that offshoring of our processes. So we'll see. We'll see how that goes. And as far as automation, that's picking up all over, picking up fast. And we're seeing all the robotics. You probably saw the Elon Musk robot that was rolled out last week, that Elon claims can just about do anything and will drive things. So we'll see how that. But we're seeing much more robotics, much more progress on that front, and look for automation to start taking over a lot more processes going forward.
Yeah. Yeah, it definitely seems that it's with the labor shortages, it's an investment, that the ROI is more favorable now, right? As both labor costs go up, and if you can't find labor, that's changing that calculation for a lot of companies.
Right.
Yeah. Let's talk a little bit about real estate. You mentioned the housing market slowing a little bit, and let's talk macro, but also talk a little bit about here in the Santa Clarita Valley what's going on. And one of the things that that I often talk about is that relative to other parts of Southern California, we actually have the opportunity for new housing and new commercial development versus a lot of areas that are more built out and land and constrained with a lack of land. What's your take on what's happening with housing and new development? It's not happening as fast as a pace in your forecast as you might have previously thought.
For the last several years, it's not happening. But yet we're seeing a breakout of residential production throughout California this year. And some of that has to do with the ADUs, which because of that law that was passed a year ago now that has allowed ADUs to be permitted quite easily within municipalities. In fact, you don't have to go through much of a formal process at all anymore in order to add them. So that's taken the state by storm. Yes, you've got much more room to move in the Santa Clarita Valley. But I guess there is still costs. There is still approval obstacles that exist. The prices are still quite high. But you do have more room to move in the Santa Clarita Valley. Now, I've just looked at some of the data that I have through August. Prices still are really not going down in California, not anywhere for that matter. Yeah, you might see statistically some of the reported median prices for housing that are a little bit lower in the last couple of months. But that's because the mix of housing selling is lower valued right now. But in general, we're really not seeing much price concession at all. We're certainly seeing sales come down, but at the same time, we're not seeing a big increase in inventory either.
Right.
So no big inventory. Sales have come down. Interest rates are very, very high. Prices are staying high. So I can't see how the real estate market is really being impacted in any major way right now. Now, will it happen over the next 6 to 8 months? If the Federal Reserve keeps raising rates, which they seem to want to have to do, we had the jobs report came out last week. And one of the first things I thought was, because the stock market sold off so badly when it did, is that, okay, good news is now bad news for the economy. Because the investor market wants to see the economy start to stutter because of the higher interest rates, because that's a sign that they're working. Okay, they're working. I think the investment community would like to see a little recession. I think you might see a rally in the stock market if you had a lot more convincing and compelling evidence that the economy was slowing down, particularly in the labor markets. Because remember, a lot of the inflation that we're getting is coming from the extremely high wage increases that we're seeing in the labor market because it's so tight. So if we can loosen up the labor market, we loosen up the wage increases, inflation starts to get stabilized, and then that will allow investors to be a lot more confident about earnings going forward.
Yeah, it shows the disconnect, or at least, if not a complete disconnect, but a time-lapse disconnect between, what's happening in the economy and in businesses on a day-to-day basis versus Wall Street and how much they're projecting forward. So I think in your report, you talked about stagflation. Maybe is that what you see ahead? And, what's kind of it's a term we haven't used in decades.
Yeah.
And now it's all back in vogue, unfortunately.
Well, I think, we have it now. And one of the best indications of it is when you see bond prices move in the same direction as stock prices. So bond prices are going down, which means that, of course, the yield interest rates are going up, and stock prices are going up. So they're moving in the same direction, which is basically a symptom of stagflation. Okay, bond prices going down because of inflation, stock prices going down because the expected earnings are going down because demand is going down and growth is going down. We've got growth going down, inflation going up, bond prices going down, and that's stagflation. So we are in a period of stagflation right now. The question is, how long will it last? Well, the Federal Reserve is doing everything they can to extinguish inflation, but at the same time, they risk, of course, putting us in recession, which I think is a kind of a done deal. The question really becomes what's the extent of that recession? So we have stagflation now. We just hope we can get by it within the next 6 months.
Okay. All right. Well, let's leave it there for now. Thanks, Mark, for joining me as always. And if you missed the SCV EDC Economic Outlook Conference, please check out our website. You can find links to Mark's slides and presentation, and download the research report that his team prepares for SCV EDC every year. So thank you again for joining me on SCV Means Business. Please go ahead and subscribe to the podcast, and we will see you next time. Thanks much.